It was March 2020, a month that would be etched into financial history. The world faced a new, unsettling reality. Streets emptied almost overnight, schools closed their doors, and a heavy sense of uncertainty loomed over every city and town. Financial markets flashed alarming red, sending shockwaves through the global economy and causing widespread panic. People rushed to sell their investments, fearing their hard-earned savings would vanish in an instant. This was raw, unfiltered fear, a stampede driven by the terrifying thought of losing everything they had worked for. Markets, powered by human emotion, revealed just how quickly fear can hijack rational thought and decision-making. Investors imagined worst-case scenarios, letting their anxieties spiral and fueling a self-fulfilling prophecy of decline. The more people sold, the faster prices fell, creating a vicious cycle that seemed impossible to break. In hindsight, it was an extreme emotional reaction, a collective panic that swept through markets everywhere. Yet markets eventually recovered, rewarding those who managed to hold their nerve and resist the urge to sell. But in that moment of chaos, logic was a luxury that few could afford or even consider. It was a true crisis of confidence, a powerful lesson in how fear and anxiety can move money faster than any news headline. Understanding these emotions, how they rise and fall, is as crucial as understanding the numbers on a balance sheet. The events of that time showed us, more than ever, the incredible power of human emotion in shaping financial markets and our collective future. Fear and greed are powerful forces in finance, like two sides of a coin. Greed is the accelerator, driving us to want more and take risks. Fear is the brake, urging us to sell and protect ourselves. These emotions change our behavior with money. Greed leads to bubbles, where prices soar beyond value. Fear causes crashes, with frantic sell-offs and panic. Understanding these emotions helps us navigate markets. They are fundamental to how we invest and react. The fear of missing out, or FOMO, is a powerful force that drives human behavior, especially in the world of finance and investing. It's that anxious feeling you get when you think you might be missing a big opportunity that everyone else seems to be taking advantage of. Imagine sitting with friends who are all investing in a tech stock that's skyrocketing. Their excitement is contagious, and you start to wonder if you're making a mistake by not joining in. You feel left behind, so you rush to buy in, often without doing any real research or considering the risks involved, just to avoid being the odd one out. FOMO isn't about logic or careful analysis. It's about emotion, the desire to belong, and the fear of exclusion from a winning crowd. During the dot-com boom, countless people invested in companies with no profits or even clear business models simply because everyone else was doing it. FOMO can push us to buy at inflated prices, swept up by the momentum and hype rather than by solid fundamentals. This is known as the greater fool theory, hoping that someone else will come along and pay even more for the same asset, allowing you to profit. As social creatures, we naturally follow the herd, believing there's safety in numbers. But this instinct can often lead us astray and cause us to make poor financial decisions. The herd isn't always right, and learning to resist its pull is crucial for long-term investing success. Following the crowd often means buying high when excitement peaks and selling low when panic sets in, an expensive cycle. Resisting FOMO is a vital skill for investors. It means having the discipline to stick to your strategy, even when everyone else seems to be getting rich quick. It's about making informed, rational decisions based on research and your own goals, not just reacting emotionally to what others are doing. By understanding how FOMO works, we can recognize its influence and avoid costly mistakes, ultimately becoming more thoughtful and successful investors. Markets have two personalities: bubbles and crashes. These are the dramatic highs and lows that define the financial world, shaping the fortunes of investors and economies alike. Greed drives bubbles, creating a party-like atmosphere where everyone feels like a winner. The excitement is contagious, and optimism fills the air. Asset prices soar, fueled by stories of overnight riches and a widespread belief in endless growth. People start to think the good times will never end. People justify sky-high prices, ignoring warnings and dismissing any doubts. Rational thinking takes a back seat as the crowd chases ever higher returns. Media amplifies the excitement, creating a powerful feedback loop of greed and euphoria. Headlines celebrate new records, drawing even more people in. But then, the mood shifts. Suddenly, fear takes over, and the atmosphere changes from celebration to anxiety. A crash is a frantic rush for the exit, driven by fear and uncertainty. Panic spreads quickly as everyone tries to sell at once. Optimism vanishes in an instant, replaced by doom and panic. The same people who are celebrating now worry about losing everything. In a crash, people sell at any price, abandoning logic and reason. The urge to escape losses becomes overwhelming. Falling prices create a vicious cycle of fear, pushing prices even lower as more people rush to sell. Crashes are faster and more violent than bubbles. What took years to build can unravel in just days or even hours. It takes years to build a bubble, but only days to crash. The speed and intensity of a crash can catch even experienced investors off guard. Understanding these cycles helps us navigate markets more wisely. Recognizing the signs early can make all the difference. It's about recognizing the signs and staying rational, even when emotions run high and the crowd is moving in one direction. Bubbles and crashes are emotional extremes in finance, showing how quickly sentiment can swing from joy to despair. They reveal the incredible power of fear and greed in shaping markets, often more than facts or fundamentals. By understanding these emotional cycles, we can make better, more informed decisions and avoid costly mistakes. Ultimately, it's about staying calm, thinking clearly, and avoiding emotional reactions, no matter what the market is doing. High emotions lead to financial mistakes. Greed drives us to chase hot tips and gamble. Over-concentration in booming sectors exposes us to risk. Diversification is key, but greed makes us forget. Fear leads to panic selling, turning temporary losses permanent. Markets recover, but selling at the bottom locks in losses. Fear can also cause paralysis, avoiding investing altogether. Cash feels safe, but inflation erodes its value. Avoiding market risk leads to long-term financial loss. Understanding these mistakes helps us avoid them. It's about staying disciplined and sticking to a plan. Emotions can derail financial goals if unchecked. Recognizing these patterns helps us make better choices. It's about learning from past mistakes and staying rational. By managing emotions, we can achieve financial success. Successful investing isn't about frantic activity. It's about temperament and staying calm. Think of investing like piloting a ship through storms. A calm captain trusts their vessel and stays the course. Emotional control helps you stick to your plan. It prevents chasing bubbles and protects from greed. During downturns, it shields against panic. Volatility is normal, not a sign of doom. Mastering emotions is key to long-term success. Achieving calm in investing requires a plan. A written plan is your defense against market turmoil. It defines your goals and risk tolerance. Money needed soon should be in safer investments. Long-term money can ride out market ups and downs. Your plan matches your portfolio to your personality. It outlines your strategy and diversification. Regular reviews keep you on track, not daily monitoring. A plan is your commitment to act, not react. Practical strategies help manage emotions. Reduce noise by checking your portfolio less often. Automate investing to remove decision-making stress. Educate yourself on long-term principles, not headlines. Knowledge provides context and reduces fear. Consider a mad money account for speculative urges. It satisfies action cravings without risking your plan. Practical tips keep emotions in check and decisions rational. It's about staying informed and disciplined. By managing emotions, we can invest wisely. Markets will always be emotional roller coasters. Fear and greed are fundamental to market cycles. The goal is to make decisions with logic, not emotion. Control your behavior, not the market. Stick to a sensible plan through ups and downs. March 2020 showed the power of staying calm. Opportunities arise during maximum pessimism. Your emotional state is your greatest asset or liability. Take a step back, breathe, and follow your plan. Invest with your head for a secure financial future.